Ever wondered how to turn a mere $5 into a staggering $500,000 in just a year? It may sound like a fairy tale, but with the right strategies, it's possible. Welcome to the world of compound interest. Often referred to as the eighth wonder of the world, compound interest is the secret sauce that can turn small investments into large sums over time. But what exactly is it? Well, in simple terms, compound interest is the interest on interest. It's the snowball effect in finance. Imagine you're sledding down a hill in fresh snow. As you roll your snowball at the top, it's small, but as it rolls down, it picks up more snow. By the time it reaches the bottom, it's become a giant snowball. That, in essence, is compound interest. Your initial investment is the small snowball, and the additional interest it earns as it rolls down the hill is the extra snow. Now, let's take a look at a real-world example. Suppose you invest $100 at an annual interest rate of 5%. After the first year, you'll earn $5 interest, giving you a total of $105. But here's where the magic happens. In the second year, you're not just earning interest on your initial $100, you're also earning interest on the $5 interest from the first year. So, at the end of the second year, you'll have $110.25. That extra quarter might not seem like much, but over time, those quarters add up, turning your small snowball into a giant one. So, the first step to grow your wealth exponentially is to understand and harness the power of compound interest. It's the financial sledding hill that can turn a small investment into a mountain of wealth. But remember, the steeper the hill, or the higher the interest rate, and the longer the snowball rolls, or the longer the investment period, the bigger your snowball, or wealth, will become. So, the first step to grow your wealth exponentially is to understand and harness the power of compound interest. Now that we know the magic of compound interest, the next step is choosing where to invest your money. There are numerous investment vehicles at your disposal, each with its unique characteristics, potential returns, and associated risks. Let's start with stocks. Stocks represent ownership in a company and offer potentially high returns. However, they come with volatility and the risk of losing your initial investment. You need to be aware of market trends and have an understanding of company financials to make informed decisions. Then we have bonds. Bonds are essentially loans you give to companies or governments. They're generally considered safer than stocks, but the returns are typically lower. The risk here lies in the issuer defaulting on their payments, but this is relatively rare, especially with government bonds. Real estate is another popular investment vehicle. This could be buying a property to rent out or investing in a real estate investment trust. Real estate can provide a steady income stream and potential appreciation over time. But remember, it requires a significant upfront investment and comes with responsibilities like maintenance and dealing with tenants. Lastly, let's touch on cryptocurrency. Cryptocurrencies are digital or virtual currencies that use cryptography for security. They can offer high returns but are incredibly volatile and speculative. The lack of regulation and the potential for loss or theft are significant risks to consider. Each of these investment vehicles has its pros and cons, and what works best for you will depend on your financial goals, risk tolerance, and investment horizon. It's essential to do your research and perhaps consult with a financial advisor before making any investment decisions. Remember, the key to a successful investment lies in diversification and understanding the risks involved. By spreading your investments across different vehicles, you can mitigate some of the risks and increase your chances of achieving your financial goals. Investing is not a get-rich-quick scheme, but a journey that requires patience, knowledge, and strategic planning. Investing without understanding the market dynamics can be like driving blindfolded. That's where financial literacy comes in. A key component to making informed investment decisions, financial literacy empowers you with the ability to grasp complex financial concepts, understand how money works, and navigate the ever-changing world of investing. You see, the world of finance is not some indecipherable labyrinth. It's a system, and like any system, it can be understood, navigated, and even mastered. Financial literacy is the compass that helps you chart your course through this system, enabling you to identify the right opportunities and make decisions that align with your financial goals. But where to start? The good news is, in the age of the internet, resources are abundant. Online platforms and communities offer a wealth of information, from basic concepts to advanced strategies. Websites like Investopedia and Khan Academy provide comprehensive guides and tutorials. Podcasts like the Money Tree Investing podcast offer insights from industry experts. Even social media platforms like Reddit and Twitter have communities where investors share their experiences and insights. Books, too, remain a timeless resource. Classics like The Intelligent Investor by Benjamin Graham or A Random Walk Down Wall Street by Burton Malkiel offer profound insights into the world of investing. However, while these resources provide a wealth of information, it is crucial to approach them with a critical mind. Always cross-verify the information you receive and remember, if something sounds too good to be true, it probably is. Financial literacy is not a destination but a journey. It's about continually learning, staying informed about market trends, and adapting your strategies as the financial landscape evolves. It's about understanding the risks involved, the potential rewards, and making informed decisions based on this understanding. In the end, investing is not simply about making money. It's about financial independence, security, and freedom. And financial literacy is the key to unlocking these benefits. As Warren Buffett once said, risk comes from not knowing what you're doing, so equip yourself with financial knowledge. In the world of investing, putting all your eggs in one basket can be a risky move. So how do we mitigate this risk? Well, the answer is diversification. It's a term you may have heard before, but what does it really mean? At its core, diversification is about spreading your investments across various assets to minimize risk. Think of it as a safety net, protecting you from unforeseen market downturns. Visualize your investment portfolio as a garden. If you only plant one type of flower and a disease hits that particular species, your entire garden is at risk. But if you plant a variety of flowers, a disease affecting one type will leave the others untouched, ensuring your garden continues to bloom. That's diversification in a nutshell. Let's delve deeper. A diversified portfolio could include a mix of stocks, bonds, and commodities. Stocks provide potential for high returns but carry higher risk. Bonds, on the other hand, offer steady income with lower risk. Commodities like gold can act as a hedge against inflation. By having a mix of these assets, you're not placing all your bets on a single outcome, thus reducing your risk. For instance, imagine you invested all your money in tech stocks. If the tech sector takes a hit, your entire portfolio suffers. But if your investments were spread out across multiple sectors and asset classes, a downturn in tech would be balanced out by stability or even gains in other areas. Remember, diversification isn't about chasing every hot tip or investing in every sector. It's about finding a balance that matches your risk tolerance and investment goals. It's about not letting a single bad apple spoil your entire basket. And don't forget, diversification isn't a one-time task. It's a dynamic process that requires regular review and adjustment as market conditions change and as your financial goals evolve. A well-diversified portfolio can be your safety net in the volatile world of investing. So, plant a variety of flowers in your investment garden and watch it bloom, regardless of the weather. While the idea of making quick money is tempting, the key to successful investing is consistency. This phrase rings true in the world of finance more than anywhere else. The temptation to chase the next big thing or to jump on the bandwagon of a soaring stock can be incredibly strong. But remember, investing isn't a sprint, it's a marathon. Let's take a look at two hypothetical investors. Investor A is our consistent investor. They invest a fixed amount of money every month, regardless of whether the market is up, down, or sideways. Investor B, on the other hand, tries to time the market. They're always on the lookout for the perfect moment to buy or sell. Fast forward 20 years. Who do you think came out on top? If you guessed Investor A, you'd be right. By consistently investing over time, Investor A was able to take advantage of dollar-cost averaging, a strategy that reduces the impact of volatility on large purchases of financial assets. This means that they bought more shares when prices were low and fewer shares when prices were high. Over time, this strategy paid off handsomely. On the other hand, Investor B, despite their best efforts to time the market, likely missed out on some of the best days in the market. As a result, their overall returns were significantly lower. This example illustrates the power of consistency in investing. By regularly investing a fixed amount over time, you can build a substantial portfolio, regardless of market conditions. It's not about making a quick buck. It's about steadily building wealth over time. Of course, Consistency doesn't mean blindly investing without considering the broader economic context or your personal financial situation. It's always important to review your investment strategy regularly and make any necessary adjustments. But the underlying principle remains the same. Consistent, disciplined investing over time leads to growth. So remember, in investing, consistency is more important than timing the market. It's a simple principle, yet it's one of the most powerful strategies you can employ to grow your wealth. We've all heard the saying, patience is a virtue. But did you know it's also a crucial trait for successful investing? Yes, that's right. Patience in investing is not just about waiting for your money to grow, it's about resisting the temptation to make hasty decisions based on short-term market fluctuations. Think about a gardener planting a seed. They don't expect to see a full-grown tree the next day. It takes time for the seed to sprout, grow, and eventually bear fruit. Similarly, the most fruitful investments often need time to reach their full potential. Now, let's take the example of Warren Buffett, one of the most successful investors of all time. His strategy? Buy and hold. He's famously quoted as saying, "Our favorite holding period is forever." Buffett's patience has paid off handsomely, turning him into one of the wealthiest people in the world. Impatience, on the other hand, can lead to poor investment decisions. For instance, someone might sell off their stocks during a market downturn out of fear, but often the market recovers, and those who held on to their investments may see them bounce back and even grow further. Selling in a panic can result in missed opportunities. Moreover, patience helps with dollar-cost averaging, a strategy where you invest a fixed amount regularly, regardless of the market conditions. Over time, this can reduce the impact of volatility on your portfolio, as you're buying more when prices are low and less when prices are high. Lastly, patience aids in avoiding the trap of timing the market. Predicting the perfect time to buy or sell is near impossible, even for experts. By being patient and sticking to a long-term investment strategy, you may be better off than those trying to outsmart the market. In conclusion, the role of patience in investing is undeniable. It helps combat fear, prevents hasty decisions, and ultimately can lead to greater financial success. In the world of investing, patience truly does pay. Economic trends can significantly influence your investment's performance. But how can you use them to your advantage? Let's dive in. Economic trends are patterns or tendencies that emerge in the overall economy. These trends can be short-term, like a quarterly earnings report, or long-term, like demographic shifts or technological advancements. Understanding these trends can help you anticipate changes in the market and adjust your investment strategy accordingly. For instance, consider the trend of digitalization. Over the past decade, businesses across sectors have increasingly shifted their operations online. This has led to a boom in the tech industry, with companies like Amazon and Google seeing exponential growth. Investors who recognized this trend early on and invested in these companies have reaped significant returns. Next, let's look at demographic trends. As the baby boomer generation ages, there's been an increased demand for healthcare and retirement services. Investors who caught onto this trend have found success by investing in companies within these sectors. Recessions and booms are other economic trends that can impact your investments. During a boom, consumer confidence is high, people spend more, and businesses expand, which can lead to increased stock prices. On the other hand, during a recession, consumer spending decreases, and businesses may struggle, which can lead to decreased stock prices. However, recessions can also present buying opportunities for savvy investors who can identify undervalued stocks. Inflation is another key economic trend to monitor. High inflation can erode the value of your investments, especially fixed income investments like bonds. On the other hand, stocks can be a good hedge against inflation, as businesses can often pass increased costs onto consumers. So, how can you stay on top of these trends? Regularly reading financial news, studying economic reports, and even following influential economists on social media can help you stay informed. By keeping an eye on economic trends, you can make informed investment decisions and maximize returns. Remember, investing is not just about picking the right stocks, it's also about understanding the big picture and how these trends can shape the investment landscape. Reinvestment is the final yet crucial step in your journey to turn $5 into $500,000. Imagine this. You plant a seed in your garden and after some time, it grows into a fruit-bearing tree. Now, instead of eating all the fruit, you take some of the seeds and plant them again. This is exactly how reinvestment works. It's about taking the fruits of your investments, the returns, and planting them back into the investment soil, allowing your money tree to grow even larger. Reinvestment is the magic trick that accelerates compound growth. Compound growth is like a snowball rolling down a hill. It starts small, but as it rolls, it picks up more snow and grows larger. When you reinvest your returns, you're adding more snow to your financial snowball. You're not just earning returns on your original investment, but also on the returns that you've reinvested. It's growth on top of growth, a powerful multiplier effect. Let's consider an example. Suppose you have $100 that yields 10% annually. If you take your $10 return and spend it, next year you'll again earn $10. But if you reinvest that $10, next year you're not just earning returns on your original $100, but also on the $10 you've reinvested. So instead of earning $10, you'd earn $11. This might not seem like much, but over the years this additional growth can add up to significant sums. The magic of reinvestment isn't just limited to financial investments. It applies to knowledge and skills as well. When you learn something new, you can reinvest that knowledge by using it to learn even more. The more you know, the more you can learn. In conclusion, reinvestment is a powerful tool that can supercharge your wealth growth. It's the act of feeding your returns back into your investments, allowing your wealth to grow at an accelerated pace. It's the magic that can help turn $5 into $500,000. Reinvestment can be the fuel that drives your wealth growth. So, are you ready to turn your $5 into a fortune? We've covered a lot of ground today, and I hope you've gained a wealth of knowledge. Let's quickly recap the key points we discussed, shall we? We started with the magic of compound interest. Remember, it's not about the amount you invest initially, but the power of your money multiplying over time. Compound interest is a powerful tool in your investment journey, and it's like a snowball that keeps growing as it rolls down the hill. Next, we talked about choosing the right investment vehicle. Whether it's stocks, bonds, real estate, or cryptocurrencies, the choice depends on your financial goals, risk tolerance, and investment horizon. The key here is to do your research and make informed decisions. Then we delved into the importance of financial literacy. Understanding how money works is crucial. The more you know, the better decisions you can make, and the more secure your financial future will be. We also discussed risk management and diversification. Remember, never put all your eggs in one basket. Spread your investments across different asset classes to minimize risk and maximize returns. The power of consistency was our next point. Investing is not a one-time thing, it's a habit. It's about regularly setting aside a portion of your income, no matter how small, and letting it grow over time. Patience, we highlighted, is an indispensable virtue in investing. Rome wasn't built in a day, and neither will your wealth. It's about playing the long game and resisting the urge to cash in at the first sign of profit. We also touched on the impact of economic trends. Keep an eye on the market, understand the trends, and use them to your advantage. Finally, we discussed the magic of reinvestment. The key here is to reinvest your earnings to generate even more returns. So there you have it. The blueprint to turn $5 into $500,000 within 12 months. It's not a get-rich-quick scheme. It's a journey, and it takes time, discipline, and a dash of daring. Remember, the journey of 1,000 miles begins with a single step. So take your first step towards financial freedom today.